Welcome to the Eggs Invest podcast series, where we explore smart, practical strategies for successful residential property investment across the UK. I'm Anna, your host here at Eggs Invest, and today, we're diving into one of the most make-or-break parts of any property investment journey, the money side of things. We're talking budgeting, financing, and how to make the numbers actually work for you, not the other way around. Before you fall in love with a location, a property, or even a strategy, you've got to know your budget inside out. That means not just asking, how much can I afford? But also, what's the smartest way to structure this investment financially? You need to factor in your current savings, your income stability, any outstanding debts, and of course, your credit score. These aren't the most glamorous parts of investing, I get it. But this is where solid foundations are built. In the UK, mortgage lenders typically expect a deposit of at least 15 to 25% for buy-to-let properties, sometimes more depending on the lender and your circumstances. So, knowing your deposit budget is step one. All right, once your budget is clear, it's time to explore your financing options. Most investors start with traditional buy-to-let mortgages. These are designed for rental properties and differ from your standard residential mortgage, typically interest-only, with slightly higher rates. But they free up monthly cash flow, which can be useful when you're managing rental income. Then there's bridging finance, a short-term loan that's useful if you need to act fast on a deal, or you're buying a property that needs refurbishment before a traditional lender would touch it. But here's something not enough people talk about: alternative financing methods. You've got options like private lending, borrowing from individuals or private firms; seller financing, where the seller essentially becomes your lender; even joint ventures, where two parties pool resources for a deal. Each of these has its pros and cons. For instance, private loans can be quicker, but often come with higher interest. Seller financing can be flexible, but isn't always easy to negotiate. The key: always read the fine print. Always compare terms, fees, and timelines, and always run the numbers to see how a deal impacts your returns. Let's talk about terms and rates. Right now, UK interest rates have been fluctuating, and that directly affects what kind of mortgage deals you can secure. So, make it a habit to check with multiple lenders, or work with a mortgage broker who understands the investment landscape. You'll want to look closely at interest rate, fixed or variable; term length; early repayment penalties; arrangement or product fees. Even small changes in interest rates can have a big effect on your bottom line. For example, a 1% difference in rate on a £200,000 loan can mean thousands of pounds more, or less, over a few years. And remember, just because you can borrow more doesn't mean you should. Stick to what's sustainable for you. Here's a mistake many new investors make. They only look at the loan amount and monthly payment. But what about the long-term cost of borrowing? You need to consider how financing will affect your cash flow, ROI, and total profit. For instance, if you're borrowing at a higher rate, your monthly profit margin might shrink, even if your property looks great on paper. Financing can also impact your tax position, your risk exposure, and your exit strategy. Will you be able to refinance later? Can you sell without huge penalties? Will rising interest rates catch you off guard? The best investors don't just ask, "Can I afford it?" They ask, "Does this financing structure align with my long-term goals?" Now let's touch on accessing capital, because how you fund your investment often determines how much return you'll actually see. Some investors use equity from their current home. Others partner with family, raise private funds, or even access business lines of credit. Whatever your route, be mindful, cheap capital equals higher returns. The less interest and fees you pay, the more of your rental income or appreciation you get to keep. Also, think about how quickly you can access that capital. In competitive markets, being able to move fast gives you a serious edge. That's why pre-approval is your best friend. It gives you clarity and confidence, and it tells sellers and agents that you're serious. So to recap, get clear on your budget and financial capacity. Understand all the financing tools available to you, not just traditional mortgages. Evaluate the total cost and impact of borrowing. And remember, the structure of your financing is just as important as the property itself. At the end of the day, smart property investing isn't just about bricks and mortar. It's about making your money work hard for you and setting up a financial foundation that supports long-term growth. Thanks for joining me on today's episode of the Eggs Invest podcast. I hope this has given you the tools and clarity you need to make better financial decisions as you build your property portfolio. If you're enjoying the podcast, don't forget to subscribe, leave a review, and share it with anyone who's ready to take control of their financial future through real estate. Until next time, I'm Anna. Take care, invest wisely, and keep those eggs in the right baskets.